If you see a stock plummet 40% from its recent highs, your first instinct is probably to assume the underlying business is broken. You look at Palantir, currently trading around $123 a share, and it is incredibly easy to point to the broader enterprise software sell-off and conclude that the AI bubble has finally burst. But what if I told you that the obvious conclusion is entirely wrong? Underneath this brutal 40% drawdown, there is a fundamental story playing out that contradicts almost everything the current stock chart is telling you. In this video, we are breaking down exactly why Palantir's commercial engine is quietly accelerating at record speed, why Wall Street analysts are projecting massive upside even after the crash, and how the upcoming earnings report could be the single catalyst that sends this stock on an explosive move in either direction. If that sounds like the kind of analysis you need before making your next move, do me a quick favor and smash the like button or hit subscribe so you never miss a deep dive like this one. Now, that all sounds impressive until you actually look at the glaring mismatch between market sentiment and commercial reality. We are witnessing a classic divergence. On one side of the equation, Palantir has suffered a massive 40% haircut from its 52-week high of $207.52. The bears have been in total control of the price action. But on the other side of the equation, the actual company is accelerating at a breakneck pace. In the first quarter of 2026, Palantir posted an absolutely staggering 85% year-over-year revenue increase. Think about that for a second. You have the stock price cut nearly in half, while the top-line revenue is almost doubling. So which side of this equation is lying to you? But revenue alone does not tell the whole story, because the most impressive part of Palantir's business right now is not just that they are growing. It is where that growth is coming from. For years, the major criticism of Palantir was that it was just a slow-moving government contractor posing as a high-growth tech company. That narrative is officially dead. Palantir's U.S. commercial segment just exploded by an incredible 133%. But even more importantly, their net revenue retention, or NRR, sits at a massive 150%. If you are not familiar with NRR, this essentially means that even if Palantir did not sign a single new customer this year, their existing clients are spending 50% more on their software than they did last year. This indicates extreme customer stickiness and creates a massive fundamental floor, which is exactly why the stock recently snapped a brutal 7-day losing streak. But could this commercial momentum alone be enough to justify one of the most expensive valuations in all of tech? At first glance, this looks like a straightforward, undeniable growth story, but one number later on makes that conclusion much harder to defend. And here is the elephant in the room. Despite the recent 40% drop, Palantir is still trading at a staggering 130 to 150 times trailing earnings. For any traditional value investor, a 130 times price-to-earnings ratio is a giant, flashing red siren. It is the exact premium valuation that triggered this recent sell-off in the first place. However, we have to look at this through the lens of hypergrowth. When a company is posting 133% commercial growth and 150% retention rates, those forward multiples compress mathematically at an accelerated pace. What looks like an absurdly expensive sticker price today can quickly transform into a justifiable, long-term accumulation target when the underlying earnings are compounding this aggressively. But does that mathematical compression actually matter if the real world throws a wrench into the growth story? Before you get too bullish, there is another layer to this, because the fundamental landscape is currently a total battlefield of opposing catalysts. Right now, Palantir is caught in a geopolitical and institutional tug-of-war. On the bullish side, they just secured a massive tactical victory against the U.S. Defense Intelligence Agency. After Palantir filed a formal protest, the DIA actually withdrew a military intelligence solicitation, which effectively cements the government's continued reliance on Palantir's commercial solutions. Add to that a newly confirmed major partnership expansion with NVIDIA, and the AI tailwinds are undeniable. But it is not all smooth sailing. Over in France, the Domestic Intelligence Agency, the DGSI, is actually replacing Palantir with a local provider due to sovereign exposure risks. And if you follow the so-called smart money, you will know that famed big short investor Michael Burry is heavily shorting the stock, citing technical weakness and famously calling Palantir a sandcastle. So what happens when one of the most legendary contrarian investors in the world is actively betting against a company that every growth metric says is thriving? With a legendary investor actively betting against the company, you might expect heavy institutional panic, but the actual data reveals the exact opposite. While retail traders might be panicking at the sight of a 40% drawdown, institutional ownership remains exceptionally high. In fact, the smart money and major tech funds are treating this sub-$125 level as a strategic accumulation zone. We are seeing prominent investors aggressively buying the dip. Most notably, Cathie Wood's ARK Invest has been actively purchasing shares during this pullback, essentially stepping in to offset the pressure from high-profile short sellers like Burry. Institutions are not running for the exits, they are backing up the truck. But is that conviction backed up by the cold, hard numbers from the analysts who cover this stock every single day? And this institutional confidence lines up perfectly with what Wall Street analysts are quietly predicting behind the scenes. If you look at the consensus among 29 Wall Street analysts, Palantir is rated as a moderate buy, with 20 of those analysts giving it a strong buy rating. But the real story is in the price targets. The mean price target right now is $192.56. From current levels, that implies a massive 57.5% upside, and that is just the average. The street high target sits at $255, which would mean over 100% potential upside. We even saw Oppenheimer recently reiterate their outperform rating with a $200 target, specifically noting that the supposed threats from large language model competitors are heavily overblown. But if the upside is that obvious, why are millions of shares still being sold short right now? Those targets are undeniably exciting, but to understand if a move like that is actually imminent, we have to dig into the derivative markets. Let us look at the short interest, because this is where the market mechanics start to get really interesting. As of mid-July 2026, there are 77.88 million shares sold short, which is about 3.59% of the float. Now, with a days-to-cover ratio of just 1.8 days, the probability of a massive, headline-making short squeeze is basically zero. However, that is not the most important metric here. Short interest has actually decreased by 10.76%. This tells us that bears are actively taking profits and covering their positions rather than pressing their bets. This removal of overhead resistance is a structurally bullish signal. So if the bears are quietly retreating, what exactly is the options market telling us about the week ahead? And that brings us to the one question investors actually care about. What exactly is going to happen next week? If you want to know what the market really thinks, look at where people are putting their money in the options chain. For the contracts expiring on August 7th, right after Palantir's August 3rd earnings report, the put-to-call ratio is sitting at a remarkably bullish 0.4 times. This means we are seeing disproportionately heavy call buying. Despite all the macro fears and the 40% drawdown, the derivatives market is heavily positioning for a definitive post-earnings rally, and traders are largely dismissing the downside tail risks. But could all those bullish bets get completely wiped out by the sheer magnitude of the move the market is pricing in? That heavy call volume sounds great, until you look at the extreme volatility that the market is actually pricing in. The options market is currently pricing in a massive 15.3% implied swing in either direction for the upcoming earnings report. Let me be very clear about what this means. The market is expecting a violent, immediate move. Based on current prices, this creates a probability cone with a bearish bound of $108 and a bullish bound of $148. This is not a slow, steady grinder. Any execution strategy right now must account for the fact that Palantir is either going to spike violently to $148 or endure an immediate brutal drop down to $108. So with that kind of explosive range on the table, where exactly are the critical technical levels you need to watch? To navigate a swing that violent, we have to strip away the noise and look directly at the technical battleground. Technically speaking, Palantir is completely trapped. The stock is currently consolidating inside a very tight symmetrical triangle, pivoting right around the $122 level. It is stuck suffocating beneath its key dynamic resistances, the 20-day, 50-day, and 200-day exponential moving averages. To the upside, we have critical resistance zones at $126.80, which aligns with the 50-day EMA, followed by $131.40 and $137.40. To the downside, the ultimate floors sit at $114.70 and $106.60. Price is coiled like a spring, and a breakout is imminent. But with so much tension building in both directions, how do we actually position ourselves for what is coming? So, with explosive fundamentals fighting against a dangerous technical setup, how exactly do we trade this? Here is the final verdict. For the long term, Palantir is a definitive buy. Yes, it trades at a 130 times price-to-earnings premium, but a business generating 133% U.S. commercial growth and retaining 150% of its net revenue entirely justifies that valuation at these discounted levels. However, for the short term, the rating is a strict hold. Because of that 15.3% implied earnings volatility, stepping in and buying shares outright right now is highly risky unless you have a mechanically structured entry plan. So what does a structured plan actually look like in practice? Which leads us directly into the exact step-by-step trading setups you can use to capitalize on this. If you want to play the short-term earnings volatility, analysts highlight a strategy called volatility harvesting. Because implied volatility is so high, the premiums on options are incredibly expensive. You can capitalize on this by selling cash-secured puts. For example, you could sell the August 7th put with a $110 strike price. If Palantir stays above $110, you keep the massive premium as pure profit. If earnings disappoint and the price crashes below $110, you are forced to buy the shares, but you are acquiring them at a deep, engineered discount exactly where strong support lies. But what if you do not trade options and just want to build a straightforward long-term share position? If you do not trade options and just want to build a long-term share position, here is the exact framework you need to follow. Whatever you do, do not buy in the middle of this $122 triangle. You are essentially flipping a coin on a 15% move. Instead, you have two logical entry points. Entry number 1 is the bullish breakout. Wait for a decisive daily close above the $126.80 resistance level to confirm the momentum has shifted, and ride that wave up to $137.40. Entry number 2 is the bearish pullback. If the market panics on earnings, be patient. Set your buy limit orders at the hard support levels of $114.70 or $106.60 and accumulate a massive long position at a steep discount while everyone else is panicking. And all of this sets the stage for the crucial days ahead. The convergence is imminent. We have the August 3rd earnings report acting as the ultimate catalyst, followed immediately by the August 7th options expiration pricing in that massive 15% swing. The battle lines are drawn. The bulls need a trigger over $126.80, and the bears are looking to push this down into the $114 buy zone. But with a Wall Street mean target of $192 and revenue growing at 85% year over year, the macroeconomic reality of Palantir's underlying business is stronger than ever. Now, before I wrap up, I have to be completely transparent with you. Nothing in this video is financial advice. I am not a licensed financial advisor, and this content is for educational and entertainment purposes only. Every investment carries risk, and you should always do your own due diligence and consult with a qualified financial professional before making any investment decisions. Past performance and analyst projections are never a guarantee of future results. With that said, here is the bottom line. Structure your entries, stay patient, and let the market resolve this $122 pivot before you deploy your capital. The fundamentals are screaming strength, the technicals are coiled for a breakout, and the next 7 days could define where Palantir trades for the rest of 2026. Now I want to hear from you. Do you think Palantir's commercial acceleration is strong enough to justify a 130 times earnings multiple, or is Michael Burry right that this is a sandcastle waiting to collapse? Drop your take in the comments below. If this analysis helped you see something you would have missed, hit that like button and subscribe to the channel so you are locked in before earnings drop. I will see you in the next one.